Welcome to the Nichols Tax Update Podcast, issue 2135. This program is produced to provide current information about developments in United States tax law. That's the standard disclaimer, along with my acknowledgement in preparation of this program of my subscription to Tax Notes Today. Tax Notes Today is published by tax analysts. In my view, the preeminent source of information for tax professionals, and it is from the material that I get from Tax Notes Today and tax analysts that I glean the topics for this program each week. What is in this week's program, by the way? 7 items, a fact sheet that will be helpful to claim the advanced child tax credit or stop it, by the way. Rent for space on fiber optic cable is real property rental income. That'll be important to a real estate investment trust. An audit techniques guide, and yes, that is plural, on property foreclosures has been revised and is important. The penalty for failure to report listed transactions is the subject of a practice unit, IRS training material produced. This one happens to be 20 slides for training their own auditors. Then a tax court decision that a real estate developer loses the net operating loss that he claimed, and I'm not so sure that it's the correct decision, so stay tuned. The Tax Inspector General points out flaws in the IRS exams of S corporations and what flaws they are, by the way, on the issue of shareholder employee compensation, or, if I may, lack thereof. And finally this week, I'd like to comment a little bit on the employee retention credit, as the IRS has given us the rules for operating that in a notice 2021-49, I believe. The Advanced Child Tax Credit Fact Sheet tells you how to navigate the Advanced Child Tax Credit Update portal, to sign up for direct deposit, to change bank account information, to stop payments, or to make any other administrative change. The rules are that's where you can manipulate the system from your computer to direct the advanced child tax credit to a new bank account, or stop the payment, save it up for later, accelerate, or make sure you get the payments, whatever it takes. And if you're a non-filer, you can go there as well. This is a letter ruling. It would only be important really to a real estate investment trust or to a fiber optic cable company that wanted to get investment from a real estate investment trust. The amounts paid by unrelated third parties for the use of fiber optic cable are real estate rental, and providing related services, whatever those might be, that's described in the letter ruling, for less than 15% of the rental value will not give rise to impermissible tenant service income, which would be immediately taxable to the REIT and not a pass-through item to the REIT's beneficiaries. An audit techniques guide, and yes, the plural is appropriate, on property foreclosures has been revised. It provides guidance to IRS agents who are examining cases involving real estate foreclosures, cancellation of debt, short sales, on how to properly calculate the taxpayer's income when the taxpayer's property has been foreclosed, or when the taxpayer has received release from debt, or the taxpayer's property has been the subject of a short sale. The guide focuses on the tax consequences and explains what happens when the taxpayer receives a Form 1099-C. There are 2 other publications I think that might be helpful here that are related, that you and I need to have some knowledge about. That would be topic number 431 on the IRS website, Cancel Debt, Is It Taxable or Not? And then publication 4681, which is for the taxpayer. Publication 5550 is for the IRS agent, auditing the reporting of debt cancellation transactions. Publication 4681 is for the taxpayer and CPAs like you and me that are trying to do the taxpayer's return on how to report the information. So the IRS has guidance and we have guidance. The penalty for failure to report a reportable transaction is explained in a practice unit, and it is illustrated on this slide. The return is audited. The IRS discovers that the taxpayer did not report their participation in a reportable transaction. There will be a penalty. Well, maybe not quite as serious as that slide suggests, but serious enough. The fine is a lot of money. The types of transactions which are enumerated in the law are listed transactions, confidential transactions, transactions with contractual protection, lost transactions, and transactions of interest. Now, listed transactions are specifically identified by name, by this particular transaction. The last four, confidential transactions, transactions with contractual protection, lost transactions, transactions of interest, are identified by their characteristics. A transaction has not been specifically identified by name, but rather by its characteristics in items number 2, 3, 4, and 5 in that list. Items at number 1 are specifically identified by name. And those are the listed transactions that we're talking about in this in this explanation of penalty, as little as $5,000 or as much as $100,000 for an individual who fails to report their participation in the designated form. The estate of Charles P. Morgan, an insolvent real estate developer. Now, the estate is not insolvent, but the real estate, the company that was in the home building business, apparently is insolvent. A federal judge has placed the affairs in the hands of a receiver, and Mr. Morgan, before his death, was busily engaged in trying to get reestablished in the home building business or some related enterprise. The court ruled here that Mr. Morgan is not eligible to deduct losses from the expenses incurred in trying to establish a new home building business, because seeking a business is not carrying on a trade or business. And this is where I have a difference, because I believe that Mr. Morgan had a 24-year record of building homes. He built thousands of homes in the Indianapolis area. So he was an experienced home builder. He lost the control of his company. It makes sense that he would be seeking another company to do what he knew how to do best. So I don't know that this is an estate, whether the attorneys will be energized to pursue this or not. I think the tax court made a mistake. They do. They're not perfect. Another area where they were not wrong, by the way, the estate of Charles P. Morgan intended or tried to claim an NOL carryover from 2009. The NOL was established in 2009. There it was. It was reported on the tax returns, but never used. There was no income to use. Now there's income, and we need to use that NOL carryover. The statute of limitations has run on the return, but the statute did not run on the NOL. If we now seek to use the NOL, we have to prove that there was a net operating loss. We didn't have to prove it back in 2009 because we weren't claiming the benefit. But we're trying to claim it in 2017 or 18. We're claiming the benefit. We have to prove that the expenses were incurred and we're entitled to the benefit. There, the tax court is correct, and that's an important thing for us to understand. the statute of limitations can run on the return that produced an NOL, but it did not run on the NOL itself. So when the time comes that you want to claim the benefit of the NOL, you should be prepared to support the expenses that gave rise to the NOL, just as you would have supported those back before the statute ran on the return itself, the return when the NOL arose. Comes as a surprise to accountants sometimes. IRS exams are flawed. Who knew, right? Found this little guy in my clip art collection. This is a report from the Treasury Inspector General. Over 500,000 S corporation returns received in 3 years, 16, 17, and 18, were not selected for examination, despite having profits greater than $100,000, a single shareholder, no reported officer compensation, and distributions. Those corporations reported $108 billion in total profit, shareholder distributions in excess of $69 billion, and finally, no Social Security wages, no Medicare. That's a loss to the Social Security system of over $3.3 billion. And finally, wait a minute, what? Finally? I thought we just did. Well, we could finally. 151 of those S corporations actually reported in the 1120S having a non-resident shareholder. That wasn't enough to attract the attention of the IRS, so those returns were not audited. Is it that bad? Yes. Now you're your client's advocate. Can you consider that lax enforcement when recommending compliance with the law? Our ethical standards, Circular 230, say no. The AICPA statements on standards for tax services say that we can't consider that a return may not be audited when giving tax advice. So we have to counsel compliance with a law that is apparently not being enforced. Can't make this stuff up. The employee retention credit, a little bit of confusion here. The IRS has grabbed a definition of related party for persons whose wages are not eligible for the employee retention credit, but the definition they grabbed was so complete and so all-encompassing that it forms a burden for owner-managed, family-managed small businesses. Family-owned businesses are more likely to employ family members who are legitimately working, and but for being the owner's niece or the owner's brother, would earn wages that qualify for the employee retention credit. The only way wages paid to family members can qualify for the credit now is for Congress to change the law. That's what the IRS says. They're not going to change their notice. Yeah, by the way, here's a list of the persons whose wages are not supported as eligible for the employee retention credit. This is the definition of qualifying relative. In Code Section 152D2, the broadest definition of familial relationships contained anywhere in the Internal Revenue Code, applied to limit the availability of the earned income employee income credit. Employee retention credit. I'll get it right. I don't think it's right. Well, that's it for another week. Thank you for your attention. Thank you for your support. Remember, stay safe. We need each other to get through this.